Sunil, it's good to have you with us at a time when we continue to see Asia earnings estimates continuing to rise. But at the same time, on the same day, we got Citi analysts now warning of more cuts in global earnings estimates. Where do you stand?
Yeah, I mean, in terms of earnings, as you just said, we have been actually, we have revised our earnings up from around 6 percentage points over the past month to around 9 percentage points, because that's largely because of the energy sector. And so we are seeing significant upgrades in the commodity spectrum, notably in Australia, and that's kind of feeding through in our overall earnings estimates. And that's a trend, by the way, we are seeing across the region. So even in US and parts of Europe, we have seen estimates being revised up. So fundamentally, looks like things are improving from an earnings standpoint. And if you look at the breadth of the current reporting season in terms of beats versus misses, actually beats have been outstripping the misses. So in general, I think on the fundamentals, news has been quite supportive.
You mentioned Australia. We have seen a lot of investors liking that market, but at the same time, if you're making the call because of commodities, we have very commodity dependent on imports like South Korea and Japan. So what happens to these import dependent economies?
Yeah, I mean, specifically for some of the import-dependent economies, as you said, we have generally taken a tactically sort of cautious view there. So we have lowered our view on Korea. We have also taken our view on Taiwan down to underweight. I would say the general preference we have in the Asian markets is sort of favoring domestic over sort of globally sensitive markets. And so that will sort of favor ASEAN markets for ASEAN, Singapore, and Indonesia in general, but also we like China because of the favorable risk reward and policy put there, but generally sort of underweight the globally sensitive markets of Korea and Taiwan, sort of neutral to underweight there.
So, Sunil, I want to ask you more about your China strategy, because even as we have the government announcing this big infrastructure push, this is kind of the old playbook when it comes to stimulating and getting the economy back on track. We're seeing investors much more interested in the consumer side, right? This chart showing that CSI 300 infrastructure, that index has started to lag the 300 consumer discretionary index since about mid-April after a very strong months in the 12 months prior. So do we see the opportunities really within that consumer-facing space?
Yeah, that's right. I mean, we just published a report this morning on refreshing our thoughts on China. And I would say in terms of the areas we like, they are largely kind of benefiting from the policy stimulus there. So that would include things like consumer services, given the improvement on the COVID situation we are seeing and the ends of lockdown in Shanghai. So consumer services, parts of the entire sort of transportation sectors are the ones we favor. But at the same time, I think given the continued focus on government on stimulus, we do think some of the property sector as well as the capital goods should benefit. So these are the four sectors I would say would benefit because of the stimulus as well as reopening.
We talk to a lot of analysts, and it's very clear that binary risk is really to do with government regulation, right? When it comes to tech, is there enough clarity there to be able to look at some of these internet platform and tech-related names as being good buys?
I think near term, we still need a little bit more sort of clarity on that. So when we speak to investors, I would say people are a little bit still hesitant to get into the sort of the long duration sectors, especially I think the unprofitable tech. And so I think in the near term, as I said, we will still be more attuned to some of the fiscal stimulus beneficiaries or the policy beneficiaries until we start to get more clarity on the internet names, especially in the environment where still yields are globally rising. I think that will continue to put some pressure on internet names.
Sunil, I want to get your view on this kind of big question, this big existential question at the moment for the markets, which is also our MLive blog pulse question. Where do you see the biggest pain point as we see the start of quantitative tightening?
Yeah, I think, as I said, it's very clear. I think this combination of sort of quantitative tightening, rising rates, combined with sort of some growth risks we are seeing, and a stronger dollar, is what is causing pain in the markets. And we do think, even though I think the markets have generally sort of rallied in the last 2 weeks or so, if you look at the entire month of May, markets are basically flat across Asia as well as a region. And so we do think that near term it is likely to be bumpy, especially given you got this this sort of negative feedback loop where as markets rally, financial conditions actually do ease, and so Fed will have to do more. And so I think that mix will continue to put pressure on markets. Where the largest sort of pain points are, we sort of continue to be a little bit more cautious, both on, as I said, on the long duration assets, notably unprofitable tech, but also I think given the move higher up in commodities, we think generally downstream sectors and the parts where you are seeing margin pressures and the companies with no pricing or low or sort of volatile margins are the ones that could be sort of hurt the most. So in general, we are pretty underweight the entire sort of consumer durables cohort and the staples. So we think that there you could see more margin and earnings cuts.